Welcome to RealAg Live, everybody. I'm your host, Shaun Haney. Thanks a lot for tuning in today. This is our first Monday broadcast of RealAg Live. That's right. We're now doing it 5 days a week. So it's just the consistency now. Monday through Friday, 3 p.m. Eastern, 1 o'clock Mountain. We're going to do a live broadcast, a 30-minute streaming show, and really kind of do this throughout the winter since I really have nowhere to travel to. So we might as well make use of the best use we can of the studio as possible. If you have any questions, comments on anything the guest says today about the markets, you can participate by entering your comment or question in the box, whether you're watching on Twitter or Facebook or YouTube. We love to have participation from the audience. Fantastic stuff. Many questions as possible. It's always good. Today's guest is Brian Voth. He is with Intellifarm based out of Ontario now. Hey, Brian, how are you? Let's bring you in here. How are you doing?
I'm good. How are you, Shaun?
Hey, I'm doing fantastic. And I think actually you are rivaling Wheat Pete now for the most appearances. This is number 3 you've been on?
I think so, yeah.
Good for you. I think you're one. I think Pete's one ahead of you. So we'll have to fix that.
Are we stuck on this 30-minute time limit? Because last time I think we went like 47 minutes, just FYI.
Yeah, I know. Yeah, I say 30, but we always seem to go over because we have so much fun. And when we get, the more questions we get, the longer we go, it seems. So it's good times. Okay. Hey,
30-ish.
Yeah, exactly. 30-ish. It's sort of like a rough number that we're not set on hard stops here. It's not like it's the radio show or we're on broadcast television here. It's the freedom of the internet, man. We just go as long as we want to.
I guess if you get tired of me, there'll be a commercial and I'll get cut off or something.
Yeah,
so.
We lost Brian. I have no idea where he is, that kind of stuff. Okay, hey, interesting day in the markets today. Kind of mixed. Corn up slightly, 1 to 2 cents in all the near 3 months. Soybeans down actually in November, 6 1/4 to 9.96 1/4. So a little bit weaker there in beans today. Wheat in Chicago was up 6 cents. We had hard red wheat up 7 1/2. So that's a nice little lift there in wheat. Spring wheat was actually down, which is what a lot of Western Canadian farmers are interested in, is Minneapolis wheat. It was down 1/4, so essentially flat to 5.29 1/2. And the canola, one of the ones we're going to talk about here today, in November, it finished down 4 at 514.30. So a bit of a mixed day today in the markets, a bit of a Monday. So Brian, let's talk a little bit about soybeans, because that has been the one here where, there's a number of commodities that have rallied through this fall, kind of unexpected fall rally, but soybeans have really been a part of this, really the leading the charge, so to speak, as everybody kind of focuses on how much is China actually going to buy.
Yeah, it's a very counter-seasonal rally, which on the one hand, we did not really have a rally this spring at all, which you would normally see through, April, May, sometimes into June or July. We never saw anything like that really. And so we're seeing a counter-seasonal rally now. But when you look at it from the April lows till the highs from a week and a half ago, we've rallied over $2 a bushel on the nearby chart. And just even on the November alone, it was like $1.84, I think a bushel it was. And I think one of the biggest drivers behind this is the fact that the funds went from a minor short position of 10 or 15,000 contracts to being long over 200,000 contracts in this time frame. And that to me is the biggest driver behind anything on this whole move up in the commodity markets, period. And it's no surprise. The funds like to be long soybeans. They always have. It's actually relatively rare that they carry much of a short position. But what doesn't make sense to me is we've now hit the highest futures price in 2 years, a little over 2 years, something like that. And I cannot, for the life of me, build a case that says why soybeans should be this high. And I know this is going to be a very unpopular statement to make today, but it makes zero sense that soybeans are this high. Everybody's pointing to these Chinese purchases, but you got to remember, the U.S. balance sheet is banking on record Chinese purchases this year. So they're really only so far doing what they need to do in order to have the balance sheet come out at, a 400 plus million bushel carryout. The last time we had soybean prices at this level, we were talking about carryout numbers in the 100 to 200 million bushel level. not 400 plus. So this whole thing makes no sense to me other than the fact that the funds just decided that, hey, you know what? We're going to go long beans. China's been buying. We can make a case for it. Maybe soybean yields have come down a little bit, although now there's arguments that there might be a little bit higher than what was expected. And the funds took this thing and ran with it. And they ran a long way with it.
Yeah, and that's
But I
okay.
think
Because
it is.
you're saying it doesn't make sense, but it doesn't make sense fundamentally. But it does make sense when you look at what the funds are doing. And the question is, how high are they willing to push it?
You know, I talked about this last week to our clients already. I said, my concern is that we've seen the high for the crop year now.
Hmm.
There's a saying in trading, short crop, long tail. And what happens is, and it doesn't even necessarily really apply here because it's not like we have a short crop per se, but we have this perception of what may be a short crop. And so what ends up happening is you get a price that ramps up on this fear that we're going to run out of product. So in this case, soybeans. And this big price rally by nature rations demand because that is the entire function of price. High price, ration demand, low price, encourage demand, and vice versa for production. Well, it's not that we actually have a short crop, but what happens on these years, and you can look back over time, like 2012 was a year, I'm going by memory now, I think 93 was a year where you have these short crops, or in this case, this perception of a short crop, market takes this huge run up, and it basically scares everybody away from the market. And that price then just slowly comes down over the course of the rest of the crop year. And I'm not saying that's what we are in, but that is what it looks like right now.
So would you be aggressively selling your new crop into any rallies based on you think the highs are in?
We sold 100% of our soybeans last week.
You did. That's a statement.
and we sold
that's sort of like a into the middle of the table is what I see there, Brian.
Well, in Manitoba where our clients are, we've got the best soybean futures we've had in 2+ years. Plus, we actually had aggressive basis levels. So we were looking at prices, just under $12, 11.80, 11.90. When you've got strong futures levels and strong basis levels, those are both sell signals. And keep in mind, when we did our budgets a year ago or 10 months ago, the prices we were kind of roughly budgeting off of were 10.50 to 10.75. We're over $1 a bushel higher than our budget numbers. There's really no point in us continuing to hold on for soybeans. Like, what are you waiting for at that point is my question.
I hope people sold some last week. But if you look at the chart, we kind of I'm kind of going off the visual here. I don't have the full daily readout, but we basically touched in November 10.50. Okay.
Yeah.
And it is I have mine separated into a candlestick chart, and so there's a lot of green on the way up. There wasn't a lot of days where we pulled back. Okay. Now
Yep.
we are pulling back quite aggressively. Right. We have a
Yep.
pretty good peak there. When I look at the chart, I don't see a lot of resistance until we get back down to like that $9, $9.10 level. That would be a full retrenchment of the rally that we just had. Do we think we're going that far down? That's another dollar lower.
I mean, I think there's going to be some support at 9.80 on the November, which was the previous contract highs.
Okay.
So there's going to be some level of support there on the way back down. But I think there's a couple of factors really that would have to fall into place here in order to keep these prices up here. So one would be you'd have to have a lower U.S. production number. And right now, that already seems like it's somewhat penciled in. And you would have to continue to have China buying at this frantic pace that they've been at. And without one or both of these things, I just still don't see from a fundamental perspective. And you got to think here, I'm a technical person by nature, and I agree. Like, we've got this V top on the chart right now. And, V tops are pretty common. V bottoms, not so much. But long term, I still think fundamentals drive the long term picture. Technicals are short term. And that's why the funds and why anybody that trades uses technicals. But fundamentals still drive the long-term picture when it comes to commodities. So fundamentally, if you're not supported at these numbers long term, how can you stay propped up like this?
Okay, so let's flip over to the other oil seed that is, a big participant in this oil seed complex and is driven a lot by what happens in beans. It's canola. What's your outlook at this point? We've had some revisions to some of the canola carryout numbers. Of course, we've pushed above that 500 level, which is really that mental barrier that a lot of people talk about all the time, including myself. Maybe focus on it too much. How do you feel about canola here at these levels of around, plus above 510, around 515?
Canola is interesting in that the fundamental numbers do actually support these higher prices, but so I'm not really surprised at the levels that we've seen. What I'm surprised is that we've seen them in September. That's the bizarre part. These are prices I would have expected on seeing in March, April, May, as we get through halfway through the crop year, because now you've already kind of seen a better idea on what is the production actually like. And we've had 6 months worth of exports and crush numbers to actually see what demand is looking like. And are we on track for what is being penciled in? To see these numbers in September is really bizarre as well. And yes, it's tied completely to what soybeans have done. Funds there too, though, have gone from being, in March and April, pretty much a record short position in canola to, as of a week or two ago, holding not a record, but getting close to a record. I think there were along 55,000 contracts, 53, something like that. So here too, a big part of this run up in canola has been fund buying. There's no question about it. Like I said, canola at least has a supportive balance sheet behind it. But similar case now, it makes me wonder, and I'm not as sold on this one on canola, but it makes me wonder, have we seen or are we getting close to the highs of the futures for the year? I do think that basis has a lot of work to do through later winter and into spring. And, it would be one of those years where I think we can easily see positive basis levels by the time we get till May, June, July, to the tail end of the crop year, if demand goes the way it looks like it is going to go based on the last year or two.
Yeah, like obviously the EU exports have been a big we've been a big benefactor of that. It sounds like that demand will be here again from Europe through this winter. Is that what you've been hearing as well?
So far, yes. I mean, I don't want to put too much stock in that as of this point. And, with Chinese soybean buying tied with it, is likely to come some more canola buying as to politics aside, because that really isn't a factor here. Particularly, I think one thing that we got to look at is ASF in China, if their hog numbers are starting to finally rebuild. I think their numbers finally stopped going down, what was it, 4 months ago, maybe? Something like that. So their hog herd is actually starting to build back up. And this is going to be their biggest driver behind soybeans and also on the canola side, because the canola meal is going into the hog side. They want the canola for the oil for human consumption, but the byproduct of meal going into the hog side. If their hog herd is building up, they actually have a place to put it. We've talked about this too. Like, it was just, I guess, convenient is maybe not the right way to put it, but it was convenient that this whole trade war and everything all tied with ASF, because it really put China in the driver's seat. They just didn't have the demand for soybeans or canola like they've had in the years before this. So if that's kind of getting to be behind us, I think that's the bigger demand driver going forward.
What do you think on the yield number right now out of Western Canada?
Yields, they've been disappointing relative to how things looked like they should be. It's one of those years where, it looked like a 50 bushel crop, but it's coming off at 45, 44. This is Manitoba numbers I'm talking about. So it's coming off kind of at average, maybe a couple bushels below, a couple bushels above, depending on exactly where you are. So this, some of these numbers that have been penciling in like record average yields, I didn't buy it from the beginning, and now after seeing what we've seen in Manitoba, I still don't.
Can you flip back to your basis comment where you talked about the positive basis in the May June time period? Why do you believe that?
In Manitoba, we're pretty much always short canola. We have so much. There's three major crushers all within like a 45-mile radius of each other, and Manitoba's production is not that big. So you've got like 2.5 million tons or more of crush capacity annually. And it's not uncommon for us to see positive basis levels there by the time we get through the crop year because they're having to pull it from further and further west to get it into Manitoba.
Yeah. Some
So,
strong prices out there right now for canola. I haven't checked
yeah,
this week, but last week we're in the 12s. That's
yeah.
I don't need a Brian Voth Intellifarm spreadsheet to tell me I'm making money at $12.
So what percent sold are you then?
I don't know. I ask the questions around here, sir. Just yeah,
Okay.
I ask the don't listen to anything I say.
Oh,
But you know what? It's healthy. It's good to see because you think back to there's been a lot of negativity around canola from a lot of farmers, mainly because of the China issue, and we've kind of figured out that hasn't maybe negatively impacted the market as much as it felt that it would. Whether that's it's found its way to China through other routes or
right.
whatever. If all of a sudden China said tomorrow, hey, you know what? We're back in the market. Viterra, Richardson's, you got your export certificates back. Does it provide as big of a lift to canola prices as maybe some people would think?
You probably have the knee-jerk reaction regardless, because that's what kicked us down in the first place was this knee-jerk reaction that, oh shoot, we're not going to have these 4 million tons give or take going to China anymore. They're never going to buy canola again. Like, I mean, how you're in the media, you know how media hypes things up, right?
Oh, hypes all the time. Terrible people, those media.
Can't trust a word they say.
It's crazy.
So I think it would give some initial boost, but then you need to actually see the numbers backing that going forward. So, and then one hand you look at so China in the last couple of years has bought more like 2 million, maybe 2.3 million tons versus the 4 that they had been doing on average before that. But like you said, all these exports going to the EU and going to other countries, inevitably, or I think it's inevitable, chunks of that have been finding their way into China through back doors, and China is still buying. They're just maybe not buying direct from Canada the way that they had been before this.
Mm-hmm.
But again, if their demand is going to continue picking up on the hog side, it really doesn't matter what their political stance is. If they need the product, they're going to buy it.
How you feeling about spring wheat?
We got to talk about this again.
Oh, we probably should. We should. We gotta, because somebody will say, "Why didn't you ask about wheat?"
Oh man, why don't we grow it again?
It's good for the rotation. It's a fun crop to grow. People like it.
People, no, I think they like to hate it. But,
Durham's been a good story.
Okay, well, that's a different one.
That's a different one. But how about
Yeah.
spring wheat is one of our staples. Clearly, whether we want to trash it or not, it's an important part of the rotation. Everybody, always talks about how makes the jokes about poverty grass and all this kind of stuff. But what are we seeing in terms? What have you been hearing in terms of protein levels and how that's impacting some of the spreads and what it could mean for prices here from now and through springtime?
Well, I think you mentioned protein spreads. So protein in Manitoba has been slightly above average, not as high above average as it's been the last couple of years, but still somewhat above average. Yields were just, again, kind of disappointing. Just one of those years where things just didn't fill out the way it looked like. It looked like we had 70, 75 bushel wheat crops, and there were a few people that did, but for the most part, it came off average, based on long-term averages. In Alberta, we are seeing some major spreads in protein. Talking to our advisor there this morning on a conference call, he said, we're seeing protein spreads from 10.5 to 14.5. And I'm really not sure how to react to that one because it all depends on how much of the 10.5 and how much of the 14.5 there is. But, if you're heavily weighted to the low side, protein discounts are going to be horrendous. If you're weighted heavily to the higher side, well, then protein discounts aren't going to be as big of a deal. But in Manitoba, the spreads have kind of evened themselves out a little bit. Discounts are, maybe 3 cents a tenth down and 2.5 cents, 2 cents a tenth up. So really, that's just more normal than we kind of budget on 3 and 3 as an average. And so we originally did see some major discounts going down primarily from one company, and we couldn't figure out why. And it took a little while, and then they brought their numbers back into line for low pro. So, um, when you look at a chart on Minneapolis, um, it did actually have, it was, I don't know, I call it a very quiet rally because there really wasn't much fanfare or much talk about it. We did rally 43 cents a bushel in a matter of 4 or 5 weeks, which for Minneapolis is actually a relatively large move. But there too, the funds were holding a large short position. They have now bought all that back, and they did establish a minor long position as of last week, not to the extent that we've seen in Chicago or Kansas. So that does leave room for them to keep building a position in Minneapolis. And when you look at that chart, we're getting higher highs and higher lows, which is indicative of an uptrend. So yes, we've pulled back. When you look at the January highs down to the lows in August, that high at 553 that we saw in the December was a 38.2% retracement. Pretty natural place to rally up to, pull back, consolidate, and now see if we can get back going up again here. Either to that. Sorry, that was a 50% retracement. See if we can get going to the 61.8% on the next level, which is I think 564, 565, something like that, based on December. So it is in an uptrend now from about the last 5 weeks, but you're not going to have the action like you see in soybeans where it just goes basically straight vertical. Wheat just really doesn't see that, aside from one time in 2008 and 2017, I guess.
Oh, yeah, the days. Okay, so that's okay. So we were joking about how farmers sometimes, mock wheat and talk about it and sort of trash it around. Do the funds not look at it very favorably either, from the standpoint they know that spring wheat is not the one that will kind of launch higher, but they could easily push it higher? Why
they could. Yeah. It's a volume thing for them. It becomes riskier if
trying to get out of the contracts.
Exactly. And they're also limited. The funds are limited to how much of the open interest they can actually own. And so in Minneapolis, it wouldn't take very much for them to hit that limit. Similar to canola, like canola is also a relatively small market. There's a cap that the funds can actually trade at any given point in time, and it's based on what the open interest is in the market. This is why they tend to focus more on things like soybeans, corn, and Chicago wheat, and to a lesser extent Kansas, is because there's millions of contracts being traded, and it's no problem for them to get in and out of those, where you get into those thinner traded markets, and you just get a bigger spread between the bid and the ask, and you take a lot of risk on being able to get in and out.
Well, let's focus on corn ourselves here. I mentioned that December corn is trading at 366 3/4. It was up 1.5 today. So this is the commodity. We talked about it last, but typically it's the one you lead with because it leads the market. We've got obviously the final yield numbers are not in this year for the Midwest, but what can we expect from the corn market here going forward, and how does that impact our pricing strategies?
Well, corn actually, we've had a big move up here, and again, similar to the soybean side, you cannot make a supportive scenario on corn with the current ethanol situation. You can't make the numbers work, and I guess inherently that's one problem when you have 40% of your demand for a crop coming in one market segment. Whatever it is, 4.5 billion bushels a year, give or take 5 billion, goes into ethanol. And clearly in the last 6 months, that is not going to happen. And with the concerns over, second wave and whatnot, ethanol has no case for it until pretty much, I would say, until the travel industry gets back up and running. Airlines are running full capacity again, cruise ships are going to, you need this resumption in energy demand to really actually support corn prices where they are. And that said, the funds have not actually taken nearly as long of a position in corn, percentage-wise, as what they have on the soybean side. So if they decide to keep going and keep buying corn here, there's a couple of upside objectives here. I had pointed out about a month ago, maybe a month and a half ago. On the weekly chart, there's actually a double bottom pattern pointing to a 405 objective, which I looked at it back then and I was like, well, this makes no sense. Like, why would this be? And now all of a sudden it's like, huh, we're only like 20 some cents away from this.
Yeah.
And at that point, I'd probably say I'd sell 100%. We've already gotten really aggressively sold. And once we see our yields, likely we'll sell 100% too.
Is there
If
some
these prices
is there some sort of soybean corn spread? Like, because soybeans have lifted so much, like, is there a certain ratio where corn, like, it has to follow because those two are so tied together?
Usually you look at the November bean, December corn spread, and it's when soybeans are, 2.35, maybe 2.4, 2.38 times the price of corn. So it's pretty simple math. Most of the time when we're looking at this spread is when we're looking at the coming year. So in this case, you'd look at the 21 spread, and that gives you an indicator as to which way farms may look in terms of acre wise. Because if that spread starts becoming 2.5, 2.6, 2.7, basically it's saying grow soybeans, don't grow corn. If that spread starts to drop and goes down to 2.2, 2.15, then the spread is favoring corn over beans. So, I haven't looked at what that spread actually is today. But that is the one spread that we often look at just in terms of when we're trying to figure out, acreage wise, what might the market be looking at for the following year and making decisions on where and when should we be looking at pricing. So if beans start to come down, like right now, I'm going to venture to guess, I could look at it here, but right now you're at, give me a second, I got to do math.
Go ahead.
Can't do that in my head.
I can't either.
So right now, if you take the 20, November 20 beans and December 20 corn, you're at 2.72. You're way over average, which I would have told you it was over average. I just didn't realize it was actually that far above average. And so if anyone that is spread trading between soybeans and corn, like the opportunity here would be to buy corn and sell beans as a spread trade, and then that is something that, a lot of traders are going to look at as an option as well. But that's the kind of spread that you would look at between soybeans and corn.
So will we see a lot of sell beans, store corn then?
That's what that spread would be telling you right now. I'm not saying that storing corn is the best option either, for that matter. I think that, it's easy for me to say because I don't farm, obviously, I guess, to an extent. But with both of these charts and the balance sheets, it kind of says sell beans and sell corn.
Sell both.
And I'd say go on vacation, but we can't do that either. So,
So are you a believer then? Because we had, I know it was Arlen Suderman from StoneX was on RealAg Live here, and that's going back.
Oh yeah, I remember
2 months
this.
ago.
I was on that one.
Yeah, you may have asked him a question, and one of the things that Arlen said was that a risk is that China is front loading all their buying of corn and beans because they are worried about a winter second wave in the United States, and they won't be able to get crop out of port like they would want to. And so that was he wasn't saying that was happening, but there was a risk that could be the way the Chinese are looking at it. Do you buy into that possibly?
For sure. This kind of it's almost twofold. So there's that risk of them actually, being able to get the physical product, but then also of making it look like they care about or are going to fulfill their phase one commitments, which I'm really not convinced that they care at all about that. But it gives the optics that, oh yeah, look, we're buying on this pace to meet these deadlines or meet these commitments that we've made under this trade agreement. And when you start seeing, what was it now, 2 weeks ago maybe, they bought, I think, 5 cargoes of Brazilian beans all of a sudden. Like they bought nothing but U.S. beans for weeks now, and all of a sudden, a week and a half ago or 2 weeks ago, there was I think these 5 cargoes out of Brazil that they bought, and it kind of makes you stop and think, hey, like that's really early. Normally they wouldn't start buying South American beans until probably November, December, for kind of that February, March timeframe. So you got to wonder, and this would have been like right before the high on the futures market, are they starting to shift their attention to South American options now, especially when you look at at the Brazilian real and look at where currency, like South America has a huge currency advantage over the US right now too. Even though the US dollar has dropped, and that's probably one thing that should be mentioned as a supportive factor to US prices, it hasn't kept up at all with what the Brazilian real has done. So it just makes you kind of wonder at what point are they going to start shifting to South American supplies earlier? Is my concern.
If that supply is there and they can.
Well, I mean, right now you're going to be on track for another record crop. And, yeah, there's talk about La Nina or El Nino. I can't remember which one now, but it's early. If you ask one of our other advisors, it doesn't mean anything. So, but, like they're going to be watching that, obviously. But realistically, you're putting record acres in the ground. You're going to have to assume that there's going to be production there.
Yeah. There are so many moving parts from now until next spring on the China buying. You got the U.S. election. I can come up with about 5 different theories and scenarios of what potentially happens if Trump wins or Biden wins, and what happens there. And obviously, all of that impacts the Canadian trading, Canadian exports as well. And it's as we've watched here through the summer. I think one of the things the American farmer looks at is, the relationship seems to get worse and worse between the U.S. and China, but China continues to buy more and more and more. And it kind of shows maybe potentially a lot of this is sort of disattached from each other. A lot of times we look at these trading relationships as if there's like a group of people that are making all the decisions, and it's like they're all impacting each other as variables. And it just feels like there's some disattachment of that right now. Use Canada as the example. Canada's got a crappy relationship with China, and we're exporting peas like, it's been a good story for the last 2-3 years.
Yeah, and I guess this all probably drives home my point that I always make is numbers don't lie. And, and I've said it in presentations forever that China's very good at getting what they want. And, you have to assume that they're pretty good at math. At the end of the day, whether they've got issues with with Canada or with the US or with Australia. I mean, find a country that China doesn't have issues with right now. There's one common denominator. But really, at the end of the day, when they need a product, whatever that is, if that's US soybeans or Canadian canola or it's barley out of Australia, they're going to buy it. They can't afford not to. That's the thing. And so regardless of what relationships may look like, and again, how do you read into that too much? Because, you read one story and it says this, and you read another story. These aren't beer drinking buddies. This is all business. And regardless of how it looks optically in terms of, they hate each other today or they love each other today or whatever, they're going to buy what they need to buy. That's what it comes down to.
Yeah, well put. I agree with you. Hey, Brian, if somebody wants more information on Intellifarm, how do they find you and where do they go?
Best thing, just go to the website, www.intellifarm.ca. There's a contact us page there, and you'll find, I think, all of our advisors listed there, myself included, and that'd be the best way. Or on Twitter, at Brian _Voth, or at Intellifarm Inc.
Awesome stuff. Hey, Brian, this has been a lot of fun. Thanks a lot, man. I really appreciate it.
Hey, thanks, Shaun.
Hey, everybody. Tomorrow on the show, we are going to have a really, really important discussion with quite frankly, one of the leading researchers in wild pigs, wild boars. It is Dr. Ryan Brook out of the University of Saskatchewan. We had Egan Brokoff on the show, it'd be last week, and we talked about ASF. And what we've seen in Germany is, they've got some ASF cases, but they're in the wild pig population. But ASF in Germany feels like it's getting a little bit closer to home here in North America. Are we trying to do everything we can here in North America to limit the size or even possibly try to eradicate our wild pig population? Are we doing enough? We're going to talk to Dr. Ryan Brook tomorrow. If you have any feedback on today's show or you want to send me a comment or a question about anything that was discussed, you can send me an email, shaney@realagriculture.com, or on Twitter or Instagram. The handle is @realagriculture. My personal handle is @Shaun Haney. Or you can call the RealAg listener line, 855-776-6147. Thanks, everybody, for getting real and getting connected with RealAg Live, and we'll talk again tomorrow. Cheers, everybody.